Hey Cornerstone, this is John Kight. I'm doing a Cornerstone training live, and this is just some of the things that I'm thinking about right now. So I'm going to talk just briefly about booking appointments. I'm going to talk about building value, and maybe I'll throw in a few of my thought processes on the upcoming holidays. I also know that we're going to be diving into some of this on our Monday call of this upcoming week. Not sure if we will do a Wednesday call. Right now, I'm leaning towards doing a Wednesday call, just because I know so many of you guys, you will be really looking at next week as a full week, even though hopefully everybody will be taking off on Thursday and getting some of that precious family time. But I will tell you guys, just telling y'all, like when I was in the field and I had to be in the field, in other words, I was needing income, I always looked forward to these quote holiday weekends. And I will tell you, I've had some of my best sales times over the Friday, Saturday of Thanksgiving weekend. Friday was a great day to meet with people. Now, are you going to get a lot of the excuses about the holidays? Yes, okay. But, and maybe I'll dive in to somehow I dealt with that. But I will tell you what, I always, I have some of my fondest memories of meeting with some special people that if I had not been working on like Thanksgiving Friday or one of these other quote holiday weekends, I would have never helped some of the most incredible people I've helped, people that ordinarily would not have been home. And so I'll just toss that in there for you to, as you set up your week next week. Okay, so number one, on the phones. Okay, so this business, lead-driven sales, is, I think there's two things that totally drive massive production and massive profitability. Okay, number one is you got to get good at booking appointments. Okay, I think everything works a little bit. I think texting works. I think phone calls work. I would highly recommend phone calls along with text. But don't send text and not make phone. Don't guys. What I'm saying is that if you need to make money, if you've got to do this, okay? Now, there's some of you guys, you don't have to do this. I'm glad that you're here. Most people that don't have to do it never will. But the people that have to do it, guys, I'm just telling y'all, like, oh my goodness, like massive sense of urgency, not being passive at all, okay? There's a way to book appointments passively, like sending text messages, but there's also a way to aggressively book appointments, and that's through making calls all during the day and all of that type of stuff. Okay, so my phone script was like the way I acted on the phone. Okay, and here's kind of the dilemma that I have in teaching both phone script and also in-home presence or building value in the home. Me on the telephone, I was totally different than me in the home. Okay, me on the telephone, my mindset was I'm $11 hour, worker. I work in an office. Somebody put your name and number on my desk. It's my job to give you a call. You filled out this form. I've got to get the information to you. And so no matter what they told me, I'm not interested. I've already taken care of it. Whatever they would tell me, my response was pretty much always the same, unemotional, which was, that's okay. I'm glad that you've got it taken care of. Okay, what I've got to do, my job is to get the information to you. I'm glad that you got it taken care of. Bob, I want you to hear me. I hear you when you say you're not interested, okay? But my job, because you filled out this form, is I've got to get the information to you. What you do with that information, I don't care. You can ball it up, throw it in a trash can. You could do, but this was put on my desk, and I've got to satisfy their request. And so that was my attitude on the phone. I'm just a field underwriter, and my job is simply, your form got put on my desk, I'm booking the appointment, and my job is to get you the information. What you do with it's totally up to you. Like I didn't really go much, like that was my whole persona and attitude on the phone. Now, once I got in the home, once, as you guys do virtual, okay, but once I got in the home, I was a professional. I was a field underwriter. I explained my view of who I was as a field underwriter versus a typical life insurance salesperson. And I would always ask my clients, Mr. and Ms. Client, do you know the difference? If I introduce myself as a field underwriter, okay, do you know the difference in a field underwriter versus a life insurance sales agent, okay? And most times they would say no, but I would always, share my thought process there, okay? As a field underwriter, okay, I've got access to all of the top rated carriers in our state, in whatever state you're doing business. And my job is to simply get the information to you on protecting your mortgage. My job is not to sell you a policy. It's not to write an application. It's not to, I'm not this one size fits all bow tie wearing life insurance salesman that maybe you know from your hometown. I'm not trying to convince y'all to bundle your life insurance in with your homeowner so that you can get a better deal, okay? I'm a field underwriter, and I am licensed by the state to represent these top companies. I'm not captive. I don't have any incentive to write one carrier over another. And ultimately, if I get paid from the life insurance carrier. But that has nothing to do with you. My job is here tonight or this afternoon or this morning. My job is to get you the information that you requested. So whatever question you ask me, I'm going to tell you good, bad, and the ugly. Now, Mr. and Ms. Smith, I don't have a lot of time here. So do you mind if I'm transparent from the start? Do you mind if I treat you just like you were my mom and dad, brother or sister, son or daughter, okay, in whatever age group they were? And so as we launch into this, my first goal is always to find out whether my clients need it, okay? So you guys may have already had that discussion. I want to hear what your thoughts are, but I've got my own few questions set up that really lets me know whether I need to leave here, making sure you guys are protected, or whether you guys are already in good shape. So do you mind if before we get into anything else, do you mind if I ask you a few questions, okay? And that's when I ask them about their, maybe I'll look on their form, maybe I'll verify their mortgage amount, their mortgage lender, has it changed, whatever. Okay, number one, income-wise, what do each of you bring in per month, okay? So income, and I'm not going to go through my in-home presentation, okay? I'm going to talk about building value, but I go through income, assets, and the way I ask about assets is what do you have in place? What do you have in place that would act as life insurance if something were to happen to you? Do you have a lot of money in a bank account? Do you have an inheritance that you've gotten that maybe you stuck it in a bank account or a bank CD or something like that? Do you have a big retirement account? Do you have anything that would protect your beneficiaries if something were to happen to you? So number one, income. Number two, assets. And number three is existing life insurance. Guys, if you're not asking about existing life insurance, and if you're not stopping your presentation to look at their existing life insurance, you are messing up, okay? Because your client already has a life insurance policy and they're already spending X amount of dollars. The way I always looked at that is that I want to make sure that they have the very best coverage in place. Most of the time, I just wanted to make sure that they had the coverage that they thought they had, okay? but I wanted to serve my clients that way because if they're already spending $30 a month or $80 a month, I wanted to make sure that they were getting what they were paying for. And oftentimes, I would stop right there and I would simply harvest that $80 a month, and I would redirect where they were spending the $80 a month because it was not the best coverage that they can get, and I would redirect that first in their mind. I would redirect that to a better coverage. Then we would talk about any additional coverage if they can afford it. But guys, most people, they've got a threshold. Most middle income America, they've got a threshold on how much they can afford for life insurance. And I'm telling you guys, most of the time it's around $80, $85, $90 a month, somewhere in there. And so anyway, so income, assets, existing life insurance. Okay, number 4, you've got to find out their insurability. So you've got to ask their health history. I'm not going to go through that today, but now I do want to get into something that I really do feel like matters, whether you help somebody or not. Okay, you've got to lead people from a thought process standpoint. Okay, now, mortgage protection. Everybody knows what mortgage protection is. It's when you get the 32-year-old married couple, they've got a kid on the way, or they've got 1 or 2 kids, they've got the $350,000 mortgage, and boom, yeah, mortgage protection. Hey, Mr. Breadwinner, we're going to put this $32 a month term policy in place with living benefits, and we're going to put it in place for 30 years. We'll do an annual review every year, but for 30 years, you'll have a level term. If anything were to happen to you, your wife here, your beautiful wife, Ann's going to walk away with a level benefit. It's not decreasing, okay? And so every year that you pay on your mortgage, your life insurance will actually create more value, and it has living benefits, and I go through explaining that. But guys, it's a $32, it's a $28, it's a $20, it's a small monthly premium, right? Somebody told me one time, John, it takes just as long to write a $20 a month premium as it does a $200 a month premium. And I've never forgotten that. So when I learned real mortgage protection, what I learned was how to create value with people that were older. Older people drive the mortgage market, and it's been that way, guys, since the mortgage market came back from the 2008 crash, okay? Prior to 2008, all of those fake mortgages, and anybody could qualify for anything. You know, if you could fog a mirror, boom, we're going to give you a loan. And you guys saw how that ended up. But since the mortgage market has come back, okay, it says I'm getting a slow connection. I don't know what that means. Since the mortgage market has come back, and definitely since the mortgage market really kicked into gear 2015, 16, I'm just going to tell you guys, like older people drive the mortgage market. So if you think there's less value in somebody over 50, 55, or 60, if you think there's less value in mortgage protection than the 25, 30, 35-year-old, you are sadly mistaken. I made my living, and I made a dadgum good living. You know, I made over $200,000 a year on my own pen while I needed it, okay? I had to do it, okay? I had no other income. I had to do it, and so I had to go out and cash flow $5,000 a week, and I did it predominantly in an area called, it's U.S. Highway 17, and I did it from Jacksonville, North Carolina, which is Onslow County. I did it down through Pender County, New Hanover County, Brunswick County, and then I ended up in Horry County, South Carolina. So there's a stretch right in there that I know every neighborhood, I know every nook and cranny of that area, and I'll never forget it. It changed my life. But predominantly, I met with older people that were moving down south. They didn't want to move all the way to Florida. Okay, they didn't want the high prices of Charleston area, so they wanted to move down south, and so they settled along the coast of North Carolina. And so I got to understand really well how to build value with people where mortgage protection didn't mean mortgage payoff. Okay, so here's the way I did it a lot of times. When I sat down with the 50, 55, 65, even 70-year-old, if they had their insurability, I would always talk to them about where they were right now. Okay, you've got your insurability, you're healthy. So really smart people called actuaries, they would insure you, which they don't like, okay, but they would insure, you've got your having your insurability is an incredible thing, okay? So I would always talk about insurability and what a gift it was, and how so many people had health events happen that they had lost their insurability. So having your insurability, number one, is fantastic as long as you take advantage of it, okay? Then I would talk about their mortgage protection does not mean mortgage payoff. And here's what you guys, okay, so let's take an average 62-year-old couple, okay? 62-year-old man, 62-year-old wife. The man's the breadwinner, okay? They just moved in. They have really no equity in their home right now. But here's what I want to do. 62 years old, couple, okay? I'm not putting the policy so much in place for today. I'm putting the policy in place for 10, 15 years down the road. And here's what I want to communicate to them. Over the next 10, 15, 20 years, hopefully you guys will be healthy. Hopefully you guys will go into old age healthy and just building incredible memories here. But statistically, here's what I know. I know that when men get into their early to mid 70s, definitely into their late 70s, they run a much higher risk of something happening, okay? Maybe it's not death, but it is something that usually takes their insurability away, and that's why insurance companies hate them. Insurance companies and actuaries, they hate them because of the increased risk over females, okay? So I want you guys thinking that your largest life insurance policy, it is going to be growing over the next 5, 6, 7, 10, 15, 20 years, and that's actually the equity in your home. So what I'm going to recommend to you guys is that you take and put a small permanent policy in place. Don't put a policy in place that's going to end 10 years from now. I mean, Joan, do you think Bob, or Ann, do you think Joe is going to pass away in 10 years? Look at him. He's healthy. Now, we're not saying he's not, but like if you look at him right now, or do you think something's going to happen? No, I don't think anything's going to happen. I don't either. So instead of putting a term policy in place that only lasts 10 years, let's put a smaller permanent policy in place. And here's what the purpose of the policy is going to do, okay? The purpose of the policy is to take care of at least 12 months of mortgage payments, so that if something happened to Joe, and whether he lost his life or he lost his insurability, you've got a permanent policy in place that guarantees you at least 12 months of mortgage payments being taken care of. Now, here's what I'm saying. Here's my emphasis on at least 12 months, okay? 12 months is the time period that most people say that if you did lose your spouse, you don't need to make any major decisions for 12 months. I mean, think about it, Ann. Something happens to Joe. Y'all have already been married 40-some years. I mean, it's like, think about it. For 12 months, you need to wake up, put one foot in front of the other, and you need to figure out now the direction of your life, okay? And so for 12 months, in this case, you've got a life insurance policy. It's not a big life insurance policy, but it's one that y'all can afford, very affordable. And what y'all did was y'all financed now 12 months of more. What you know is that Joe is paying the mortgage for 12 months from the grave, and you don't have to worry about anything for 12 months, okay? So emotionally, 12 months is a big deal, okay? Number two, let's also look at the fact we don't know what the mortgage market is going to be like if Joe passes away in his mid to upper 70s or early 80s. We don't know what the mortgage market's going to be like. So if you did have to move and you didn't want to stay in the home, or you couldn't afford to stay in the home, you want to be in a position to harvest the largest amount of money from your equity. You don't want to be in a position, Ann, where you've got to fire sale the house. You're going to discount that life insurance policy. You're going to discount that life insurance policy by possibly $100,000 or more. Why would you want to put yourself in a position to do that? So let's say Joe passes away. The housing market is not strong. Would 12 months at least allow for enough time to pass for you to be able to put the house on the market at the best time of year, and possibly allowing the housing market to come back so that you can harvest the most amount of your equity? So what I recommend today is that we take out a small policy on Joe. It's a permanent policy, okay? We're going to be able to put this in place if Mutual of Omaha, through their product Living Promise, if Mutual of Omaha accepts the risk, okay, it's going to cost you less than $100 a month, so y'all won't even think about it. It'll be on auto draft. But this policy will put it in place, and it will cover more or 12 months of mortgage payments, okay? And so that's what I recommend for your mortgage protection, which isn't so much mortgage protection as it's equity protection, because it's not a policy that's going to pay off your mortgage. I mean, Joe and Ann, here's the thing. Nobody in their 60s can afford a mortgage protection policy. Think about it. Look at these actuaries. Look at how much they price these term policies. And you've got a 30-year mortgage, 30-year term policy, and you're 65 years old. And so we have to protect what's most important, and that's the equity in your home. So guys, Cornerstone, I wanted to teach that today, and there can be different variances of that, but I do want you to get to the point where you know how to create value for people, that if you try to show them mortgage protection, you're going to be showing them $200, $300 premiums, monthly premiums. You can't do that. That's not serving them well. They're middle income America. They cannot afford that. And so if you don't build value around what's most important to them, which is not mortgage payoff, it's protecting their biggest asset, which is their growing equity. So I hope that makes some sense to you. Guys, I look forward to seeing you on Monday, because we're elevating, okay? We've talked this week about going from treating your business as a hobby to a real corporate career. We're going to talk about if you're choosing virtual sales, we're going to start off with a goal of at least 2 same-day appointments. So when you start work on Monday, if you're working $3 leads, or if you're working IVR incomplete leads, or if you're working just data, okay, or you're working your warm market, your goal for Monday is to set 2 appointments for that day. Now, you might set 2 appointments for Wednesday or Tuesday, but it's not Monday, so they don't count. Now, they'll count when you get to Tuesday, but you want to get in a habit of doing at least 2 appointments that you booked same day. Guys, that's gonna help you get to where Connor and Deanna and Tanya and Nicole Hansen, that's gonna help you get to where these giants are that are booking 6 to 8 appointments a day. They're booking 6 to 8 same day appointments. But how can they do that? Well, they do that because they're working A-leads, okay? We talk about that all the time. So I hope that you enjoyed this training. I hope that you get to watch it sometime this weekend. And I really hope that it makes a difference in you, because I will tell you, if you're working the lead business, the majority of people that you'll be able to serve and that you'll be able to communicate with are older homeowners, people that are over the age of 45, 50 years old. And here's the thing that's going to set you apart. The people that have called on them and have talked to them about protecting their mortgage, they did not know what I just taught you. They didn't know it. And so you're going to be able to really separate yourself in the mortgage protection market by understanding how to do these things, okay? So protecting equity for these people over 50, 55, guys, it is a must that you learn to do that. So thanks for plugging in today. Thanks for watching this video. I hope it helps. And I look forward to seeing you Monday morning at 9:14. The daily card table, not the daily round table, that'll be at 10 o'clock. Okay, this is the people that are sitting at the card tables, not the big adult table yet. Okay, but we've got to start where we are. Okay, and if you can't afford $2,500 a week on A-leads, join the crowd. But we're going to start where we are, and we're going to definitely build up to that and get you to be a household name in the Equus financial world. So God bless.